presentation.
Yeah, thanks, Brian. And as Brian said, we're the goal here is to provide education and guidance on financial topics, um, and to make sure that it's accessible to everyone. And it might not, it's not just investments and pensions that we speak about. It's everything from state benefits to helping fill out forms for whatever it is you may need, but it's assistance with it. The main thing is financial topics, but obviously there are kind of a lot of areas in life that lead into um, have a financial aspect to them. So today is primarily about, well, two of everyone, two of the largest assets that most people will have to their disposal. And that is one, your property, and two, your pension savings. So in my meetings with people as members of WIMCO, pensions have come up a lot, as has property and advice attached to how they utilize their property, whether it be mortgage, whether it be inheritance tax, or just passing over and passing down on legacy planning. And pensions as well, because obviously we talk about savings, investment savings, state pensions, pension credit, and accessing your pension for the first time. So I wanted to get everyone together to give you the concepts, the overarching concepts of these things, to allow you to go back home and then see, okay, do I need further advice here? What questions should I be asking? So I've got invited Ken Wade here, talk about the first of those large assets, which is your property, and how to access that for an income, essentially, and the ways that you can do that through equity release. So Ken's going to do a little bit about that, and then I'll move on and explain on a high level some of the main questions that we have about pensions. And the idea is, if you have more questions or you think anything that we speak about today might relate to you, just give us a call for the contact details that you'll see at the end. Book in a meeting and come speak to us in more detail about your specific situation. So I'm going to load up a presentation and then we'll get started. With Ken's. Let me just share my screen. All right, can you all see that? Screen sharing, fine.
Yep.
Great. So just before we start, go ahead. I want to explain that I'm a qualified financial planner, financial advisor, and I do give advice. But today we're talking about guidance and education, right? So none of what we say today is advice. If you want specific details about around your situation, come to us, speak to me, speak to Ken, and then we'll point you in the right direction for advice. But yeah, that was all done through Wickham Multicultural Organization, and we'll provide the details to get in touch with us for more information on how to get a booking. So Ken, do you want to start and just introduce yourself, and then you can go into equity release?
Yeah, sure. Thank you very much, Nathan. Thank you, Brian. Let's talk about equity release. I think many people have probably heard about equity release over the years. It's nothing new, but what has happened is it's been heavily regulated now, which it needed to be. And from a personal point of view, I think what we have on the table now is something that is very, very accessible to us as a community, and also very, very useful, but only in specific situations. So the information that I'm going to be sharing with you today is going to hopefully give you an idea of those situations where it would make sense to do it. So as Nathan said, two massive assets that we're going to own in our lifetime. Most people will own their own home and their pensions. My whole conversation now is around what can we do with your home? See, I think the issue that we've all had is we've got this huge asset. It keeps going up in value, but in truth, we don't know what we can do with it. And some of the options that we have got available to us is not so accessible because it means we've got to look at our income. It means we've got to look at all these other things, our credit ratings, and sometimes these things don't give us what we want. But let's zoom in on what equity release actually allows us to do. So first of all, this is only available to people who are age 55 and over. And the whole idea of it is to be able to access cash that is tied up in your property. Some of us refer to it as equity, which is the correct term. Now, the most important thing here is we want to access this money, but we don't want to sell the property that because it's our home. Neither do we want to be moving out. So we just want to release the money and we want to release it tax-free. And in most cases, you can have a monthly repayment or you can have a lump sum. It just depends on what it is that you're looking for. Let me just talk through the two variations of equity release. The first one is referred to as a lifetime mortgage. This is probably the most common in all of the UK, and it's probably easier to think of it like this. A lender, a mortgage company, releases money to you. They do not remove your ownership. You still own it. If you go to land registry, your name will still be on there. But just like when you take out a mortgage, the lender will put a charge on your property. And when they've put that charge on your property, they can release that money because that charge gives them some security to get this money back at some point. And we'll look at that a bit later. The good thing about equity release, though, is that you can roll up. What do we mean by roll up? You don't have to make monthly payments. These payments are added to the amount that was given to you. And at a certain point in the future, when the property is sold, then the money that you got released is repaid, and all of the interest that you've rolled up is repaid. So that's called a lifetime mortgage. The second type of equity release that you've got available to you is called a home reversion plan. Now, this is where you literally sell a part of your property to a provider in exchange for a lump sum. Now, if you were to go to land registry for this one, you would see your name and the provider's name as joint owners on this property. Now, there's no rolling up of interest on this one. There's no deferring of the capital because they actually own a part of it. So what happens now is whenever the property is sold, you'll get your share of the equity, and the other owner, which is the mortgage provider or the provider, will get their share of that equity. So the big difference here is on this second one, which is not so popular, you are selling a part of your property. You're selling a part of it to somebody else and becoming a joint owner. With the first one, lifetime mortgage, you stay the outright owner, absolute, but there's a charge placed on it. Now, one of the great developments in this area is my third pillar here, which is in the past, there was this worry about, okay, if I'm not paying interest each month, is there going to come a point where the interest has rolled up to such a level where I owe more than my property is going to be sold for? And that's a big concern. But as long as as long as you do all the things that you're supposed to do in the arrangement, there's an absolute guarantee that there will never be a situation in the future where your property's being sold and the interest that's being rolled up puts you in a negative equity situation. So let's look at a couple of examples quickly, just to show you some of the things that people may want to do with this money that they've taken out. Well, Margaret owned a property at 320. She wanted £800. She was getting £800 a month on her pension, and she basically wanted to do some work to her house. And as you can see here, she releases 40,000 using the lifetime mortgage, which is the first one we spoke about. And she makes some adaptations or some modifications to her property. And then she holds 15,000 as cash. Now, this is good because it gives her better quality of life and it gives her some reserve funds. As we said earlier, she stays in the property. She's not asked to move out. She'll never be asked to move out because she owns it. And she has a financial cushion, which is something that she didn't expect, but it's a nice thing to have. Home improvements done, the cushion is there as well. She's age 72, and as you can see there, there's no issue about a person's age. It's a question of, is the equity there? David and Susan, another situation, 450,000 with no mortgage. Daughter wants a deposit on their house, and I think this is something that we may look at, because in the current market, the way properties are going up in value, we just can't get our children to save enough money to get their deposits. But what you can do is use equity release in the right situation in order to release that, not put any pressure on yourself, like what happened with David and Susan. They gave the daughter £60,000, which was tax-free. And that also reduces the value of their estate for inheritance tax planning. So that's another subject that I think we spoke about before, where every time when a person dies, 40% of your estate over a certain number gets paid to the government. Well, if you've taken money out, i.e. equity, that's reducing your estate value. So now you're reducing your inheritance tax. What's the outcome of all of that? Reduced inheritance tax. She's able to buy her first home and everybody's feeling happy. Now, here's another one. Robert, who's 70, he's got a state pension, and Nathan will talk about the defined contribution pension, which gives him £1,400 a month. But it's not quite enough to cover all of his expenses. Now, what we can do with the equity release is we can release some money so that he can draw down £500 a month and not take all of the equity at once. And that minimizes the amount of interest that's being charged. But he has a facility to take as much as £80,000 at the rate of £500 a month. So what does that do? Gives him a nice retirement income, and it means he can stay in his home, enjoy everything that he was enjoying before, and also control the amount of interest that is being rolled up. So that's a very quick overview of how equity release has been used in the past. It is one of the last options. Before looking at equity release, you should be looking at, should I downsize? Could I take some money out of my pension? Have I got a savings plan that I can cash in? So there's a list of things that the advisor will go through just to make sure that this is the right thing for you to do. In terms of the process, and then I've finished my part. If this was something that you thought, well, hold it, I can't do anything else, but I do need some cash, then, as Nathan said, come to either of us and we'll point you in the right direction. The advisor will sit down and talk to you about your current situation, doing a complete fact find, looking at things like the age of your property, income and financial needs that you're looking for, any existing mortgage arrangements you've got or debts that you've got, any family considerations and inheritance wishes that you've got. And then having done that fact find, he'll make some recommendations, pointing you in the direction of what the interest rate will be that they'll be charging you on the money that you've taken out, what your maximum borrowing would be, if there's any early repayment charges associated with that. He'll also look at the impact of the inheritance tax or any benefits that you are taking. Once that recommendation has been made, the next thing that they'll do is carry a valuation of your property. Once they've satisfied themselves that the valuation of your property meets what they're looking for, then they'll issue a offer, and the offer will tell you what the loan amount or the released amount is going to be. They also tell you the interest rate they're going to be charging and any terms and conditions. You will need a solicitor, so you'll need to get some independent legal advice, and they will explain the mortgage offer and all the other legal matters and confirm your understanding of the agreement and complete any legal work that's necessary. And then they'll push forward for the completion. And then from there, as we've said, either on your death or if you're admitted into a nursing home permanently, then the sale of the property will take place. So that's about it from me. I don't know if I should be taking questions now, Nathan, or do we wait till the end? I'll leave that to you.
Yeah, sorry, Ken. Let's wait till the end for questions. And I'll just finish up on a last point on equity release. But if you have any questions, just keep them in mind, and then bring them up at the end of the meeting. Um, so I'll just add to that very briefly. And thanks again, Ben, for coming. So, while a financial advisor can kind of give you an overview on all the different solutions that you can utilize, um, equity release is one solution and a quite specific solution, as Ken said rightly so, is often like the last option after looking through a number of different solutions first. And then with that come a different products, which Ken went through. And it's understanding whether those products are right for you, which is not something that I don't personally specialize in, which why I've asked Ken to come in and give you this breakdown on it. Um, Now, one thing I would say when talking about equity release, my family's Caribbean background. My mother's Jamaican, dad's Guyanese, and I understand on a personal level how much property and brick and mortar means to people from the Caribbean community, the African and Caribbean community. We hold it quite high, and there's a load of reasons for that historically. Um, but I would say the main things are the security that a house provides, making sure that, your home, when you own it, no one can take that from you. And the more, paying off your mortgage throughout most of your life provides a massive target for someone to achieve. And once they do that, they kind of hold that as something they've completed and it's done. They don't want to do anything with their property after that. And it's obviously quite an emotional investment because it's something that you live in and raise your family in. But having done financial planning for a while now, 13 years this year, what I understand is that the biggest thing about thinking about your assets and how you utilize them is tax efficiency. And Ken mentioned in the presentation a few times how these options could reduce inheritance tax or pay out a tax-free lump sum. But tax efficiency is probably above all one of the most important aspects of your own financial planning. And it's a concept that isn't talked about in the African and Caribbean community a great deal. We talk about how to make more money, we talk about how to earn more money, how to make more profit, but we very rarely look at the costs and the tax that we have to pay as a result of that. So equity release is quite specifically a way to access assets or money from your assets in a tax efficient manner. Um, so it's worth considering. Depending wherever your situation is, always worth a consideration at least, just to talk through with an expert and understand how it saves you tax and if it saves you tax. There are many other good reasons and great reasons to do it, but tax efficiency is what is a big one. Okay. Is there anything you wanted to add last of all, Ken, before we move on?
No, I mean, I'm really glad that you brought the point out about the tax efficiency side of it because, in actual fact, when working with private clients, those who we call high net worth, those people who have over £1 million in investable cash, uh, this is the sort of thing that they use because then they can access money, live off that money, and that's how they get away with not paying lots of tax. Whereas what we're tending to do is to earn lots of money, pay 40% tax, in fact, 45% tax. And then we're wondering why we've not got as much money as we probably should have. Whereas, I say, other people, high net worth clients, they use these type of funding mechanisms to get around the tax, to make not get around it, but to make things tax efficient. So thank you for raising that point.
Yeah, yeah. And I mean that goes to, so that's the same with earning money and also and accessing your money and also legacy planning. So it's something that if you're considering, it's definitely a conversation to have with the family, with children that inherit these properties because they can do so at such a much more efficient rate. But yeah, again, high level, so we won't go into too much detail. But again, if you want more information about that, please get in touch with Ken directly or you can have a discussion with me at the hilltop or over the phone, and we can bring Ken into the conversation later. But yeah, let's move on to pensions. Obviously, something that everyone probably has experienced to some degree. If you've been enrolled into a pension or you've accessed a pension before, or you're receiving state pension at the moment. Um, so yeah, the slides up here will give you a breakdown on what I'm talking about. I won't go into them too much detail, but they to help you if you want to go back and look at this video as we're taking a recording, you can have some context to what I'm speaking about. But yeah, main differences. So pensions, main differences, and this is something that gets confused quite often, is the difference between a state pension and a personal pension, right? State pension is a government state benefit and it's provided to everyone who's made national insurance contributions throughout their lifetime. At the age of, well, at the moment, earliest age you can get it is 66, and it often rises. So for most people now, it's probably 67. And it's pretty secure. I know there's a lot of information there about how the state pension could disappear. How could they make it means tested? But I would just focus on what we know, and what we know is that it's going to be here for the going forward. It might, there might be some changes, in the future, but there have been conversations about that for years, years and years and years, even before I started this profession, and nothing really has changed yet. And our incomes for people receiving state pension is still going up. So that's the state pension. Now, most people will have some sort of personal pension. However, it wasn't an obligation for an employer to have one in place until quite recently. So the government introduced something called auto enrollment, which means now everyone who gets a job has to have a pension. So to some degree, if you're working now, you will be enrolled into a defined contribution scheme. In the past, the most common of pension was a defined benefit scheme. And we'll talk about the difference between the two. Defined contribution is also known as a money purchase or personal pension, and defined benefit also known as a final salary pension. Okay. So state pensions. If you want to check a state pension forecast, you can do that by the government website. I added a link up there as well. Like I said, you increase the amount you receive at state pension. There is a maximum limit. The full state pension at the moment is £221.20 a week, which is going up in the new tax year. If you have 35 years of qualifying years of national insurance contribution, you get the full state pension. But you can, if you don't have those qualifying years, top up your national insurance contribution through various different ways. And if you have questions about that, it's best just to come speak to me and talk about different ways which you can do that because there are actually quite some niche ways to increase your benefits and access to the state pension. But high level, it's the main thing to know here is that the state pension is a state benefit. It cannot be changed. It is what it is. You will receive it, and you can access it at the age of at the minimum age of 66. When we talk about personal pensions, this is a completely different access age, which is usually 10 years earlier than the state pension age. So the first one I'll talk about is the defined contribution, money purchase. So this is the most common now of pensions that you'll see. If you're working, you'll have one of these. Often, you'll be enrolled into a pension and you'll get a letter from an administrator. Now, what's important to understand is the difference between the pension, which is the product. This is the thing that wraps around your money to make it tax efficient. The administrator, this is who looks after your pension and the investment. So what your pension is invested into, what the money in your pension is invested into. There's a clear difference between the three. So to give you an example, let's say you work for Toyota. That is the company you work for. Okay. If you're enrolled in a Toyota pension, because as I've mentioned with all companies, they have to enroll you in a pension scheme, take a portion of your wages and contribute into a pension on your behalf. And then also take a portion of, they also match that contribution by adding further money into the pension for you. And that all goes in tax free. They will do that through an administrator. Now, the administrators, there are many. Some of the common ones now are Nest, People's Pension, Now Pension, Standard Life, Aviva, Aegon. There are a lot of different administrators. So if you get in paperwork from any of these companies, that is the administrator of your pension, the people looking after your money. That's the people you call up to say, where's my money? How much is in there? What can I do with it? They won't advise you, but they will give you the ability to make decisions about your pension pot. Um, the funds it invested in, the funds that money is invested in, is separate to the administrator. Okay. Remember, your pension could be invested in anything you want. It could be completely in cash. It could be in cash. What it will be is a money market fund that's invested into cash funds, which might be a topic that's a little bit more in depth. But the thing to understand is there is a key difference between where your money is as an invested and who looks after it. So Standard Life might be the people looking after your money, but it's invested somewhere else completely. So if Standard Life fails, disappears tomorrow, your money is still safe and invested into a fund. If that fund fails, which well, for most pensions, they're invested in a million different funds, so it's unlikely they all fail at once and you lose everything. Um, if that fund fails, then yes, the value may go down even to zero. That's the risk because it's invested and there's a risk of losing your cash. But most pensions are invested in a diverse range of assets, but looked after by an administrator. And then that administrator uh, will be in communication with your employer to see how where the money's going into from your wage packet every month. So that's a clear difference. Um, Now, the key thing about money defined contribution pensions are that this is a pot of money, just like a bank account, that is yours. It's yours and you can do what you want with it. You can only access it once you reach retirement age, which at the moment is 55, but raising to age 57 in 2028. So you could access your pension from age 55. How you do that will have different tax consequences. So very quickly, in terms of the tax on how a pension is taxed is when you're accumulating a pension, when you're adding money to it, there's no tax to pay. That's the benefit. That's the main benefit of using a pension pot. You're getting your income, it's going to your pension, you're not receiving it in cash, therefore you're not paying income tax. You're allowing it to grow, investment growth. All the investment growth is tax-free. Now, when you come to access it at age 55 or after, you have a couple options, and your pension provider will write to you about these options. Sometimes they might be very wordy letters and you might not understand it. That's precisely the situation where you should come to us and ask us what that means. But those options allow you to access your pensions in different ways. The first way is flexibly. You can access them flexibly. That means you can take the whole pot all at once if you wanted to, or you can take little bits at a time. That's basically what flexible access means. The thing to understand is, while pensions have been growing tax-free and you haven't been paying income tax on any of the money because you haven't been receiving it, once you do start to receive it, there's tax to pay. It basically becomes an income for you that's taxable at your rate of tax at that point in time. But there is a catch to that in that you can get 25% of the full amount tax-free. And that's your tax-free lump sum. And then providers often people often know about that because they know they can access a lump sum of money completely tax-free. And that's 25%. Can be more. It can be more in some certain scenarios. But it's always a minimum of 25%. The other 75% of your pension is taxable. And we'll talk a bit more about that in a second. Now, the other option is an annuity. And a lot of you would have heard about annuities before. But annuity, to give you a very quick explanation of what it is essentially by taking your pot or a portion of your pot, paying it to an insurance company, and saying, I would like an income for the rest of my life until I die. Now, what this means is it takes the risk out of your hands and puts it onto the insurance company. And it allows them to say to you, well, we can guarantee you this income forever. Now, why that might be a good option is because you may say, okay, well, I've got £100,000 in the pension pot. This might not last me for as long as I need it to last me if I keep taking out as much as I need every year or every month. But one thing I can do, I can have a look at my basic expenses, my basic needs, and say, well, I need £1,000 a month. Go to the insurance company, ask them what they would give me for £100,000 of a pension pot. And if they say, yeah, we'll give you £1,000 a month, now you know that you'll get £1,000 a month for the rest of your life. No, guaranteed, no risk. And that's essentially what it is. Now, there are different reasons why you may or may not take an annuity option, but essentially it turns a defined contribution pension into something more like a final salary scheme or money purchase pension, where you just receive the income and you don't have to worry about it again. So before we move on to defined benefit pensions, let's talk a little bit about the tax-free allowance very briefly. 25% of your pension pot is tax-free. 75% of the income is taxable when you access it. Now that's important, when you access it. So let's take an example. You have a £100,000 pension. You take 25% of it tax-free. The way in which you do that is quite specific in nature, okay? You will have to crystallize or essentially withdraw. Crystallize basically means withdraw. Withdraw the whole amount, but it doesn't all come to you instantly. Withdraw the whole amount. So 25% of that whole amount now is tax-free, which you can take into your bank account. The question is, what do I do with the other 75%? I don't want to have to pay tax on it because if I take £75,000, I'm paying tax at 40% if I have no other income. So where does it go? That goes into what's called drawdown. It can go into a drawdown fund. And that just places it into another type of fund that's still essentially in your pension, but means that you can access it whenever you want. But until you do, there's no tax to pay. But if you say, okay, I want 10,000 from it, then that's going to be taxable money. If you say I want £1,000 of it, it's going to be taxable money. So 25% can take tax free. The other 75% of it you can take or you can put into drawdown. But when you take that money, it's taxable at your rate of tax. Okay. So if you have no other income and you take £12,570, it's taxable, but obviously within the personal allowance, it's taxable at 0%, meaning you wouldn't pay any tax on that amount. So let's now look at defined benefit pensions, right? Final salary schemes. Now, a lot of people who've had pensions in the past, 30, 40 years ago, when they started, there'll probably be some sort of final salary scheme. Essentially, it's just saying, okay, you worked in this place for this amount of time, therefore you are able to receive an income of X amount, any amount, per annum for the rest of your life. The income is guaranteed, it won't run out. It stops when you die. Often there is um, an income paid to the spouse on death. It's often protected by inflation, means it goes up with inflation. And you just don't have to think about it. It pays out an income and that's it. There's not much flexibility to it apart from when you first access it. So if you get sort of paperwork saying you've got a final salary scheme, it will often have a few different options. Now, essentially, the main thing, without reading into it too much, the main thing is you can have a certain amount of income and you can take a lump sum at the beginning, which is your tax-free cash lump sum, basically, but they will determine how much that is. So they might say, okay, well, you get £1,000 a month for the rest of your life and you get £10,000 up front. You can essentially say, I'd rather more income now, so a bigger lump sum now, and a lower income for the rest of my life. So they might say, okay, you can have £15,000 now, but we'll only give you £8,000 now as an income for the rest of your life. Or vice versa, you could have a smaller lump sum or no lump sum at all and a higher income for the rest of your life. That's basically the options they'll give you, but they'll look different depending on the administrator that looks after your pension. So the key difference is we've talked about state pension, a separate thing. It's a state benefit that sits on its own. Defined contribution and defined benefit are personal pensions, they're your own money. And the main differences between them are, I would say, firstly, the flexibility. So obviously the defined contribution pension is a pot of money looked after by your scheme administrator, so Standard Life, Aegon, whoever, and you can tell them exactly how you want to take that income. You can say, I want to take a lump sum, I want to take an income from it. Whatever you want to do, that's your money to do with what you want, right? The defined benefit one, once you make that choice in the beginning, which is restricted anyway, that's it. You get your income. That the amount that you chose is what it is. It might go up with inflation, but that's it. And once you die, it stops. So limited flexibility on those. The investment risk. So you're in with the defined contribution pensions, this pot of money that's looked after by the administrator, you're essentially looking after that and deciding what you do with that. Where is it invested? How is it invested? What's the risk? There can be really good rewards to that in the long term to get more growth and maybe take an income where you don't even touch the capital. But in the long term, also there's risk that that it might decrease in value depending on what's going on in the world. If there's a war like there is right now in Iran, it's likely that the value will go down, and it will obviously last you a lot less time if the value is going down. Whereas with the defined benefit scheme, as we talked about, it's guaranteed. There's no real risk there. The main risk really is the flexibility allowed to you in how you pass it down to someone else. So obviously with the final salary scheme, when you get an income, if you die, that income stops. Yes, sometimes there is an income paid to the spouse. If you're married, your husband or wife will get an income for the rest of their life, a lower income, usually 50%. But if there's no husband or wife or dependent per se, the income just stops. So that means if you take a final salary scheme, or you take an annuity, which is like a final salary scheme, and you die the day after you start taking it, that income is just gone. Whereas the defined contribution, like I said, is a pot of money. So you die, that pot of money is in your estate and it will pass down to your children or your wife or whoever. There will be tax consequences, but that's just something to discuss with an advisor on on how that affects you and how to manage that tax efficiently. So that really is everything in terms of a high level of how pensions work and the difference between state pension, defined benefit pension, or final salary schemes, and defined contribution pensions or personal pensions. The main things I would implore you to do if you have questions about this is firstly, check your state pension, understand what it is, and if you could get more income. There's also pension credit. If you haven't got enough state pension to cover your expenses, you might be able to get a top up through pension credit, another state benefit. Um, and if you're not receiving state pension yet, get a state pension forecast via the government website and have a look at what the income is and whether or not there will be ways to top up your national insurance to increase that income so you get closer or up to the maximum income. If you feel like you've had pensions in the past that you can't find, there is a tracing service. But to be very honest with you, it's not the kind of thing where you put your details in and it just finds your pension. It doesn't really work like that. You can put in very detailed information and it will try to um, see who the administrator is of that pension. So it might say, okay, where did you work and how long did you work for there? From what dates to what date? The likelihood that the administrator is this place, and they've been taken over by this company and that company. So you contact this person and then you can go there and find it. Um, there are quite a few pension providers, but there are a few large ones like the Standard Life and Willis Towers Watson, where they would have hoovered up a lot of the smallest policies. So if I would recommend, if you don't know where your pension is, use a tracing pension service first, but then just contact the big companies like Willis Towers Watson, give them your information and national insurance number, and just say, "Have you got a pension for me?" That's one way to do it. But yeah, obviously at Wimco, you have access to myself. Come along, ask questions. There's impartial guidance and education, and I can give you a bit more detail about what I spoke to about here. And if you need beyond that financial advice, then yes, we can provide that for a fee. And that's basically essentially going through everything that going through all your current circumstances, understanding your situation, making a plan, and then putting that plan into action for you, which I can explain in more detail on a one-to-one basis. So that's our information details, and I think I'll open back up to Brian, and he can just lead the questions, if that's okay.
Okay, thanks, Nathan. Thanks, Ken. Okay, has anybody got any questions? You can raise your hand, or if you want to just go speak out, that's fine. Everyone's shy. So, Nathan, one question for me.
Sorry, yeah, go on.
So, yeah, for the state pension, so it had in there that you have to have 35 years of national insurance contribution. Can everybody go on mute so we can just 35 years of national insurance contribution. So I've got a lot of friends that are self-employed. If they haven't got 35 years, is there like a sliding scale? So let's just say they had 15 years.
Yeah, absolutely. So every year you're building up part of that income. So if you've got, I mean, I'm not sure if it works exactly like this, but if you've got half the amount of years, you're going to get half the income, basically.
Oh.
But self-employed people, if you're doing a tax return, you'll see option on there on making national insurance contributions. And if you're making class three national insurance contributions, you will be building up those years. So even self-employed people can build up national insurance contributions necessary to get the full state pension.
Right. Okay. Henry, floor's yours.
Thanks, Ben, Nathan, for that excellent presentation. My question goes to the first speaker. You talked about the sample you gave about homeowners where people who have paid their mortgage completely. I don't know what happens to people who are still paying their mortgages. Number one, and two, people who have, again, buy-to-let properties. What are the strategy in terms of releasing equity on those property? Because not everyone has fully paid their mortgages. So how do you address that? Thank you.
Kenny, you wanna go
Ben,
on?
you're on mute. Yeah.
Oh, sorry. Yeah, that's a very good question. Thank you for that question. So the answer is something called loan to value. You don't necessarily have to have all your mortgage paid off, but what they will want to do is to take a first charge on your property. So they'll pay off the mortgage that you've currently got and make sure that they don't exceed a certain percentage of the value of your property. So if we take an example of, say, £300,000 property valuation, and you've got, say, £100,000 in existing mortgage, they'll give you a maximum of a percentage of that 300,000. Let's take 50%. So they'll take it up to 150, which will mean they pay off the 100,000 and release to you 50,000 in the same way that we've discussed earlier. So it's about what they call the loan to value ratio. So you don't have to have unencumbered or a cleared property with no mortgage. It can still be done if you have a mortgage, as long as it doesn't exceed a certain percentage of the total value. Does that answer your question?
It does in a way. However,
Yeah.
there's need for clarity, in the sense that, just imagine, especially for people from our community,
Yeah.
and you're paying a mortgage, you are maybe 50 something years, and you decide you have about 100,000 left on your mortgage.
Yes.
Decide to take to release equity to be
Yes.
efficient, maybe.
Yes.
What happens to your monthly repayment? Because that could affect your wages and things. Your monthly repayment is bound to go up because you've taken more loan from your lender. So we need to understand the pros and cons, especially for people from our community. Could you please articulate that point so that there will be well defined understanding and application of what you've just said to people?
Sure. So back to the principle of equity release. With equity release, the benefit is that you do not have to meet monthly interest payments. So without giving specific advice, the principle simply says, if there is a mortgage there at the moment, and then you pay off that mortgage with your equity release provider, then that mortgage monthly payments will cease, because now you will begin to roll up the interest. As I have explained earlier, nothing is paid each month. It's added to the loan, and then on the sale of the property, capital that you were released is paid, plus all of the interest that's been rolled up month by month. And that's how they get their money at the end of the day. Or if you go into long-term care, the same thing will apply. Does that answer the question?
Well, I don't think the question is, if the homeowner, they've not finished paying their mortgage,
Yeah.
and they have equity release. What happened to their monthly repayment?
Yeah. Okay. So let's use the example. The homeowner at the moment has a mortgage with Nationwide, and their monthly repayment is £500 per month. That's the scenario you're giving me, right? When we go to an equity release provider, they will pay off Nationwide completely. So Nationwide will no longer be in the equation at all. So now you're in a situation where the principles that I spoke about earlier, any interest that is due each month, you no longer have to pay. It gets rolled up, which means it gets deferred, delayed until either the property is sold or you move into long-term care, at which point the property will be sold by whoever the executor or the lasting power of attorney is whilst you're in long-term care. So the point here is that original mortgage is paid off completely. So there is no more mortgage payments to make because now the equity release mortgage provider says you don't need to pay anything. We'll just keep rolling up the interest.
I think
Is that
I think would it be fair to say, Ken,
yes.
you wouldn't have an equity release product to release equity alongside an existing mortgage, so you wouldn't have the two at the same time?
No, that's correct. You wouldn't. These two, what they would want to do is to pay off that first mortgage and be the only one that has security over that property.
So I guess what we're saying is that you are, you're giving up the benefit of increasing your equity share with the mortgage, what the mortgage does, because you're every day you're paying off the mortgage, you're increasing your equity share. So you're relinquishing that benefit for the benefit of not having to pay interest on the mortgage, having this equity release and paying off completely, so that on death, that's when the creditors essentially get their money back. Would that be fair to say?
Yeah, that's it. That literally is it. That's literally it. Yeah. That's
So
right.
I think, because I don't know, correct me if I'm wrong, Henry, but I think the understanding here is to understand in a situation where you already have debt against the property, where would equity release fit into the equation? Is that the question here?
Yeah, correct. Absolutely right.
Yeah.
Just to throw more light on that, I think, how do I put it now? I understand, especially for my community people, because we work hard for our money. We have to be very careful of making decisions on equity release to avoid a situation where someone is 55 years old. As one is getting older, there are so many things. This weather is cold, prone to sickness and things. We need to really think properly. When you take equity and you've not finished paying your mortgage, what are you going to do with that equity? When you take an equity, realistically, you are taking more money. It's a loan, and your mortgage monthly payment goes up, increases. So you have to take consideration of that increment. And so taking an equity release when you have an existing mortgage, if, for example, like I said, your mortgage when you bought your property, it was 100,000. Now it's about 300,000. You want to release equity from there. When you want to remortgage it again, your monthly repayment goes up. And at 55, so what do? You have to be very, very mindful. What do you do with the money? Do you have any plan you want to give to your children to buy them? There are so many things to be considered. So, because like I said, the example you gave was people who have paid their mortgage outrightly, but not people who are still have mortgage paying. So, especially for my community people, it matters a lot to understand equity release, how it works when you are still doing. It's good to have equity release. I'm an advocate of that because I'm an entrepreneur. You use the money wisely. Don't put money in the bank. What you do with the money is more important to invest. I believe in investment. So I'm just contributing to this and talk as well. I'm into properties, so I understand what it takes to manage and give advice. So it's do what you guys are doing, Nathan, and Ben. Both of you.
Yeah, that's good. Thank you for that, Henry. Of course, what we are talking about here is individuals who may have a mortgage, but the point is they must have quite substantial equity in their property. If there's only 10, 15% equity in the property, it's not going to work. Because in the main, I think you'll find that most equity release companies won't go above 50, 60% of the value of your property, even if they pay out what you've already got. But at 55, if you had a repayment mortgage, for argument's sake, and you only had £50,000 left on it, but your property's worth 400,000, you can see that there's some flexibility there to release some equity. But you're right to it's why we need to make sure that the individual sits down with an advisor and goes through the specific situations. And as I said in my opening statement, in most cases, this will be the last resort that a person will turn to, because as Nathan rightly said, there's a lump sum option from your pension. Would be better. Could be that you downsize, would be better. Could be that you cash in an investment, that would be better. Could be that you sell a buy-to-let, that would be better. So in the specific advisory environment, the options would be discussed. And if all else fails, but you absolutely need this cash for whatever reason, children, education, to give you a bit more income because you're not meeting your expenses, that's where the equity release could be a solution. So it's just really raising the awareness.
I think that, just to finish on that point, and thank you, Henry, for your question. And I think it's important with all these conversations that we are raising the risks, basically. To at the end of the day, with regards to financial planning and any product that financial planner, what anyone tries to tell you about, whether it's pension, investment bonds, equity release, it's all products. It's all the product that someone's trying to sell you, make money from selling you, right? These things can benefit you in specific circumstances, but it's the exact reason why you speak to an advisor that you trust that can tell you if it's right for you. For most people, the majority of people, equity release is not really going to be on your radar. However, there are specific circumstances where it can be very, very helpful and tax efficient, like I said. Now, it's very hard to lay out those specific circumstances because everyone's families are very different. But, one of the most common ones is if you're trying to protect the value of the property or the property itself from the state when someone goes into care, for example. Now, the mechanics of that can be quite complicated and ones that I'm not a specialist in it by any means. But by understanding the context of how certain products and certain things can help us, we can then sort of explore them at the right time rather than, not finding out about them. But yeah, so just because we're running out of time, I think we should probably move on to the next question.
Yeah, so I think there's Sam. Sam has put a question in the chat.
Yeah, I saw that.
Okay.
Thank you, Sam. Very good question. Let me just make sure I'm reading that right. So I think so the question is, if you have two or more pensions, you take 25% from each, or should you combine them? Very, very good point. The first thing I would say is to, for a second, think about your pension pots. These are personal pension pots. State pension, forget about that for a second. Personal pensions, think about your pots as one single thing. Yes, they are separate administrators, and they are given to you with, they send you letters to say, this pot is worth that much, this pot is worth that much. But think about them in your mind as one single thing. Your pension is one single thing. So yes, if you have two or more pensions, you could take 25% from every one of them. You're taking 25% across the board, regardless, right? That's because at the end of the day, it's one single pot of your pension. They all add together. Um, so you can access them one at a time because you'll have to go to the administrators separately to say that you want 25% tax free. But you can access them one at a time. You can access one and not the other. Should you combine them is a very good question also because first of all, there's no need to do that. That's the first thing. If you want to take money from all of them, there's no need to combine them. The second thing is combining pensions basically means transferring one pension to another pot, right? So if you've got a pension with Standard Life and a pension with Aviva, you might say, oh, the Aviva one's pretty small. Let me just put that into the Standard Life one because it makes sense and it's easier to do, easier to look after, which is true, probably. It's easier to contact one person. However, by transferring, you're immediately losing all the aspects of the Aviva pension. And sometimes, in some specific circumstances, there are benefits of that pension. So through the years, pension rules have changed a lot. So they were, either you could contract out of the state pension, for example, or you had increased access to tax-free cash. So you had more than 25%. Or there might be guarantees that made it so you wouldn't fall below a certain value if the market did really poorly. And those kind of guarantees are really important to keep. And if you transfer a pension from one place to another, you lose it, which is why it's really important to get advice and to speak to an financial advisor to say, right, I'm considering transferring this pension. Is it a good idea to do so? Now, the problem with that sometimes is if you're considering transferring a £2,000 pension into a £100,000 pension, an advisor isn't going to make any money from that. So no one's going to really want to talk to you about it at all because it's a £2,000 investment, basically. So what you need to do is get some guidance from some place like WIMCO which have got funding to do so, to give you an impartial recommendation as to if that's probably a good idea or probably not. So yeah, thanks for that question.
Okay, I don't think there's any other questions. So last one from me then. So the defined contributions you can leave to your children. I think I heard you say. So if you can leave it to your wife, but if you didn't have, let's say you weren't married, you could leave with your children?
So absolutely. So the defined contribution is the more flexible of the two options.
Right.
And that is the same with death benefits. So you can pretty much assign that pot of money, because it's just an investment at the end of the day, to anyone you wish. It doesn't have to be your wife or your husband, doesn't have to be your children, but it can be. I guess the biggest change to talk about there, which is quite relevant, is that recently our Chancellor Exchequer, Rachel Reeves, introduced pensions into the estate for inheritance tax purposes, which is obviously very important because previously, if you had a pension pot, you could basically, on death, it transfers to your spouse via interspousal transfer tax-free. So that if you're married, it transfers to your spouse tax-free. But if it goes to your children, before it's inside the pension pot, it would be tax-free. There's no inheritance tax to pay. It wouldn't even be included inside your estate. Now, that is the case. It is included inside your estate. So all of a sudden, quite a lot of people have seen that they've got these huge pension pots now that if they don't access immediately and start spending, if it goes to their children will pay tax at what will likely be 45% or 40%, but on that 40% inheritance tax, and then at their marginal rate of income tax once they access it. So double taxation.
Wow. Okay.
So yeah, I guess to answer your question, yes, it can be passed down, but now there are tax consequences of doing so.
Okay, so I think we've got a last question. Henry, do you want to go? The last question? Is that your hand up or you?
Yeah. Yeah. My it's a contribution really because I know when the speaker Nathan or Ben started, he talked about culturally we're emotionally attached to our properties and things. I think something which we're so touched. In terms of quality of life, especially for what I've learned in this society, put it this way, I noticed the system, a lot of people with big houses in terms of tax efficiency. I know I was discussing with a lady and she's a consultant and she said something that kids are grown up now, it's time to downsize. It's something which we are not used to culturally. In time, she wants to live a quality of life, have excessive disposable income. I think it's something we have to begin to reevaluate and reprogram our mindset to see how we can, in this system, in particular, this society, improve our disposable income, quality of life, embrace downsizing as a strategy, and to enjoy life because we worked so hard in this country, doing a lot of things. The kids are grown up. It's time to enjoy yourself. If you need to downsize, see it as a business strategy for tax efficiency and enjoy your life. It's my contribution to this talk. Something we're not used to. Please, a house is your asset. It's an investment portfolio for you. Use it wisely and use it to enjoy yourself. Don't wait till you are very old. You cannot walk, please. Thank you.
Thanks, Henry, for that
Thank you,
closing
Henry.
remark. So, yeah, so just to let everybody know, so Nathan is available. You've seen the link, so hopefully his contact details are on there. This video, this recording will be sent out to the community. So please share because it's shared knowledge is a shared strength. So we can all benefit from this kind of input. And obviously Ken is available as well when it comes to equity release. So it's 7:42. I think that's a wrap. And thanks everybody for attending. Appreciate your time. Take care. Good night.
Thank you so much.
Take care.